Welcome to all the participants. Here, let us see about financial instruments. See, this financial instruments, it is a part of FMS, which refers to financial markets and services. So, I have been very interested to take the subject financial markets and services, as it covers all the topics related to commerce, trading, as well as business. So, here we have to understand, as a commerce students, you have to understand a number of terms which refers to business, trading, etc. And all these terms will be covered in financial markets and services. Today let us see about the financial instruments. Financial instrument, it refers to those documents which represents financial claims on assets. So as discussed earlier, financial asset, it refers to a claim to the repayment of a certain sum of money at the end of a specified period. So, it can be said as a bill of exchange, a promissory note, a treasury bill, government bond, deposit, receipt, share or debentures. So, what is the necessity of learning financial instruments? Let us know. So, these financial instruments, it is an exchange of an instrument for goods and services that is bought by the organization. So, this bill of exchange or promissory notes, it shows as an asset in the balance sheet. Therefore, the necessity of bill of exchange should be understood herewith. So, நம்ம என்ன சொல்றோம் அப்படின்னா bill of exchangeங்கிறது it is a replacement for a goods of services for which we have brought it. அதாவது it is a bill where the quantity is mentioned here, the amount is mentioned here and the rate is mentioned here. Therefore, A or B, when they exchange goods, so A may sell goods to B. B in turn may draw a bill on A. So, this is a bill of exchange. Again, a promissory note is also as such for a goods or a claims made therewith. So, now let us see the different type of financial instruments. So, financial instruments are classified into receivables and bank balances. See, receivables refers to account receivables and bank balances refers to cash deposits. So, receivables and bank balances are again classified into debentures and bonds, cash deposits and bill of exchange. See, debentures and bonds, it refers, நம்ம என்ன சொல்றோம் அப்படின்னா debentures and bonds கடனீட்டு பத்திரங்கள். இது அரசாங்கமே நம்மளுக்கு வந்து என்ன பண்றாங்க கொடுக்கறாங்க. So why, what is the necessity of financial instrument அப்படின்னு எடுத்துக்கிட்டோம் அப்படின்னா to raise funds. So cash deposits we all know, இது என்ன சொல்றோம் நம்ம, it is a deposit that is given in the bank. So deposit raise ஆக நம்மளுக்கு என்ன ஆகுதுன்னா we get more interest. And now we have dealt about the bill of exchange. So bill of exchange, it is a exchange for the goods. So what we have purchased by the organization. And now let us deal about the capital markets. So if a financial market and services la mukkiyamanadhu this capital markets da. Idhula markets are divided into two. One is the primary market, another is the secondary market. See, primary market அப்படிங்கிறது என்ன அப்படின்னா primary market refers to beneficiary in the issuing organization. So primary, it is the first time issue. So it is also called as initial public offerings. See, for example, if a company, ABC company is there, and if it want to raise funds, the main objective of ABC company is to raise funds. So what they will do is, they issue shares. The first time issue of shares is known as primary market. And let us deal about the secondary market. So in secondary market, the primary beneficiary will be the investor or the shareholder. See, for example, the same ABC company may issue shares again, and these shares are derived by the shareholders. So they may invest in the particular ABC company, which is a reputed company. And the main objective of a secondary market is capital appreciation. So capital appreciation refers to the raising of funds by the organization to raise their working capital, to run their working capital management. And it also includes trading of securities that is already offered to the marketplace. Suppose if the same company, ABC company, is running in a good condition, it may offer more number of shares where the ABC company's share value has been raised. So these are the differences between a primary market and a secondary market. So again I will summarize. So primary market is the issuing organization, the beneficiary is the issuing organization, and the main objective is to raise funds. And here new securities such as initial public offerings comes under primary market. So secondary markets, who are the beneficiaries abina? The investor or the shareholders. So the main purpose of secondary market is to raise more capital, and moreover it includes trading of securities that is already offered in the marketplace. It's a second time issue. Now again, financial securities can be classified into two. One is primary or direct securities, and next one is secondary or indirect securities. So what is primary securities? Let us see. So these are securities which is directly issued by the ultimate investors to the ultimate savers. Here the ultimate investors may be the company and the ultimate savers may be the public. So example of primary securities are shares, debentures that is issued directly to the public. So shares we all know, பங்குகள், அதே மாதிரி debentures அது என்ன சொல்றாங்கன்னா கடனீட்டு பத்திரங்கள். So these are issued to the public to raise more funds for the company. And again let us see about the secondary securities. These securities issued by some intermediaries are called as financial intermediaries. See, listen, who are the intermediaries? The bank is an intermediary, the government is an intermediary, the financial, those companies who transact in financial transactions are called as financial intermediaries. So for example, I have given here two financial intermediaries. One is the Unit Trust of India and the other one is a mutual fund. So UTI in mutual funds, they issue securities in the form of units to the public. See, and then the money is pooled, is invested in the companies. So we will be seeing in the further slides about the mutual funds as well as venture capital, factoring businesses, so that you may clearly understand what is pooling of resources which is invested in the companies. Okay. And now let us see about the characteristics and the features of financial instruments. So we all know financial instruments are check, bond as well as bill of exchange, promissory note. So these instruments can be transferred. ஒருத்தர் கையிலேருந்து இன்னொருத்தர் கைக்கு என்ன பண்ணிக்கலாம் அப்படின்னா transfer பண்ணிக்கலாம். And those who are having the financial instrument will be the owner of the instrument. So automatically they have a ready market. So in the financial instruments, as a public, if I am having a financial instrument or share bond vachirken, alladhu I am having a bill of exchange abdina, I can pledge it at the bank and get a loan. So they have a ready market and they can be brought and sold frequently, and thus trading in these securities is made possible. They possess liquidity also. So automatically if this bill of exchange is there in our hands, it can be converted into cash immediately. And most of the securities possess security value, which we can, with the help of the security, we can raise loans. And moreover, a government employee, those who are having these securities, can enjoy tax benefits. And moreover, there are many more characteristics in financial instruments. They carry risk in the sense that there is an uncertainty with regard to the payment of the principal of interest or dividend, as the case may be. See, here, the interest or dividend, there arises some risk also. So these instruments facilitate future trading. So here there may be price fluctuations. So even the share rate may increase or decrease. So in this case, there are some risk. So these instruments involve less handling costs, since expenses involved in buying and selling these securities are generally much less. Is an advantage. The return on these instruments is directly in proportion to the risk undertaken. Of course, when there is a lot of returns, the risk which is undergone is completely forgotten. So these instruments may be a short term or a medium term or a long term, depending upon the maturity period of the instrument. So we have long term securities, we have short term securities, we have medium term securities. Okay. So with this, I'm completing it, the characteristics of financial instruments. The further slides you will see about what are the different types of instruments, how can it be traded, and what is pooling of resources, mutual funds, etc. Thank you.